Hello and welcome to the Deep Dive by CAP STRAT. Mike, the cuts are here. Figured this would be an opportune time to have a deep dive on Fed rate cut cycles, how they work, when they work or don't work, and how it could play out this time. So let's start by setting the stage for our viewers. How exactly does a rate cut cycle or a rate cut individual play out?
Yeah, mechanically, because there's not a lot of magic here when you understand what's really happening. But basically, the Federal Open Market Committee announces a reduction in the target range of the federal funds rate. They instruct the Federal Reserve Bank of New York to start executing open market operations, where basically all that's happening is the Fed Bank of New York is going to commercial banks and saying, I want to buy your treasuries. I'm going to give you bank reserves for them. It's a risk-free asset swap. Both of these things, they're almost the same. The risk-free assets. Now, because banks have more bank reserves, that lowers their cost of funding. They can borrow bank reserves from one another at a lower rate overnight. And that's it.
Yep.
Perhaps not all that they're cracked up to be in the media.
And these things, these treasuries and bank reserves are almost identical.
Yep.
But one big difference is one gets counted in the money supply, right?
Yes.
So we've broken this down into things that always mechanically happen anytime the Fed cuts rates, and then things that happen most or some of the time. So let's start here. What always happens anytime rates are cut?
The money supply increases because you increase the supply of bank reserves. The Fed can create bank reserves. They created bank reserves out of thin air. Cash yields always go down. You'll see that in your money market funds, especially over the next 7 days. Rates tied to the Fed funds rate will go down. So if you have an interest rate that's referenced to the prime rate is referenced to Fed funds, therefore it will go down. A lot of credit card loans are prime plus. Those will start to go down. What happens most of the time is banks' capacity to lend increases. Banks have more bank reserves, therefore they can make more loans. That doesn't mean they're willing to make more loans.
Right.
That depends on, are there creditworthy borrowers and good loans to be made? Highly dependent on the economy. Consumers have a greater willingness to borrow. All else equal, at a lower interest rate, I'm more willing to borrow. That doesn't mean I have greater capacity to borrow. So there's always that mismatch that's extremely important. Just because the Fed lowers rates doesn't mean banks are going to go nuts and extend credit to everybody. And long-term interest rates most of the time come down. There, think 30-year fixed-rate mortgages. Most of the time they come down in a rate-cutting cycle, not necessarily always, and not by the same amount that short-term rates are lowered. That's key as well. And then sometimes, these are the magic things that everybody thinks rate cuts are going to do for them. Employment goes up, economic growth accelerates, and asset prices go up. Sometimes, highly dependent on the environment in which the rate cuts happen.
Yep. And speaking to the importance of that environment, we thought it would be useful to look at a couple of historical analogs in terms of the different ways these rate cut cycles can play out and the impacts they can have on the economy. Going back to the mid-90s, right, a couple of mini, perhaps, rate cut cycles. One cycle that most people consider one of the most successful rate cut cycles in U.S. history. What was the environment here? And you can see a lot of green in this column. Why did this work out so well?
Yeah, this was Alan Greenspan.
The maestro.
This is when he was named the maestro. He's on the central bankers' Mount Rushmore, basically because of this time period. We came into 1995. Economic growth was starting to slow. And more importantly, the jobs market was starting to slow. There was actually a negative non-farm payrolls print in May of that year, and it scared the Fed into making some adjustments. They had raised interest rates to tame inflation. It looked like that was about done. They can start normalizing policy, and in pretty quick order, they lowered the Fed funds rate. From there, it was sort of a pause, readjustment until we got into 1998. That's when there was more of a crisis. It wasn't necessarily in the US, but there was a Russian sovereign default, which had knock-on effects of leading to the collapse of long-term capital management, which was one of the largest and most interconnected hedge funds on Wall Street that created problems, counterparty issues for a number of commercial banks. So not only did he help orchestrate a private sector bailout of long-term capital management, you could see Alan Greenspan asserted his will on the FOMC and got plenty of interest rate cuts here as well. So this is sort of what a rate cutting cycle looks like that's proactive in a relatively healthy economy where rate cuts are somewhat stimulative. If you look at some of these stats to see how effective these rate cuts were, a lot of green across the board. Household debt service ratio went up. That means banks extended more loans, consumers took on more loans. If you're looking for a stimulative impact of rate cuts, that's what you're looking for. You're looking for increased lending, credit creation to keep the economy going or even stimulate it. Mortgage rates went down, but only by 0.8%, far less than the reduction in the Fed funds rate. And there we're talking, once again, 30-year fixed rate mortgages.
Yep.
The unemployment rate went down, initial jobless claims went down, and the S&P 500 over this time period basically doubled. About as good as you can get. That's why he's on the Mount Rushmore, because of that time period.
Yep, absolutely. And we take another example to look at in terms of a rate cut cycle that didn't quite have this significant of an impact, certainly near term. We're looking at '08, right? The great financial crisis, where this rate cut cycle was a lot quicker and steeper, but still not generating significant economic outcomes. What's the rationale there?
Yeah, I mean, think about how much the interest rate on new loans decreased during this time period. Banks flooded with bank reserves, so much capacity to increase lending, but household debt service ratios went down. By and large, nobody wanted new debt. Banks had the capacity, but not the willingness.
Yep.
Households had the willingness, but not the capacity. As a result, this was just refinancing. This was delevering. That's not great for stimulating economic activity at all. You see how long they had to keep interest rates low just to try to get the economy back on stable footing. Mortgage rates went down, but once again, by far less than the Fed funds rate went down. The unemployment rate increased, jobless claims increased, and the S&P 500 was down almost 40%.
Yep.
Totally different environment.
Yeah.
Same rate cuts, way different outcomes.
Yeah. And that, of course, begs the question, what does the environment look like today? How could the rate cut cycle play out? You know, is Jay Powell going to earn his spot on the Mount Rushmore there? Are we going to still be pushing on a string here in 2024? And that leads us to our landing scenarios. So maybe let's walk our viewers through what these different scenarios are now that we have seen that first 50 basis point cut and the probabilities we're assigning to them now, given that new information.
We'll start with the hard landing. We actually reduced our probability after yesterday's 50 basis point cut. We reduced it from 20% chance to 10% chance. Why is that? Well, one, our recession signal is still not active.
Yep.
Two, the incoming labor market data, initial jobless claims in particular, have continued to come down since early August. Three, if the Fed is willing to cut 0.5% in the absence of a crisis and in the absence of a full-blown layoff cycle, that is good in terms of saying recession probability should go down. They are clearly ready to act in a big way. So we reduced the probability of the hard landing. The immaculate landing we still have at 30%. Why is that? Well, if you look back at the roughly 150 rate cutting cycles across developed central banks since 1960, 25 of them you would call inflation abating rate cutting cycles, which is exactly what's happening now, right? Inflation was too high for too long, and now it's abating. Yep. And so you can start cutting rates. 25 instances. About half of those are inflation successes, meaning inflation comes back down to target. The other half are inflation failures, meaning you start cutting and whoops, inflation starts going back up again. Think the 1970s. Of those inflation successes, so you see we're really threading the needle here, about half of them end in a recession. The surefire way to kill inflation is to kill the economy.
That'll do it.
The other half result in a soft landing. So in total, of the 25 inflation abating episodes, 5 of them end in a soft or immaculate landing. About 20% chance.
Yeah.
Why do we assign more than that? Because history would say, 30%, that's pretty good. Well, let's acknowledge that the Fed's already in a position that nobody thought they would be in. They're starting this rate cutting cycle with the second lowest unemployment rate to ever start a rate cutting cycle and the second lowest level of initial jobless claims, even after they had to raise rates this high and keep them high for this long. So they're already sort of in unprecedented territory.
Yep.
You know, we give them the benefit of the doubt.
Sure.
Not saying it can't happen, it's just almost never happened. And then that leaves 60% probability for the no landing. There, you know, we say that the 0.5% rate cut yesterday was not indicative of the future pace of cuts. It was more so an acknowledgement that if the Fed had the July jobs report at the July Fed meeting, they would have started cutting in July. So they do a few more 25 basis point cuts until we get to the March Fed meeting. At that point, we think the US economy is probably going to respond pretty strongly to these first few cuts in terms of economic activity and hiring. And additionally, there's a worry that inflation could start to pick up again early next year, which causes the Fed to pause. There's also the wild card of the election outcome, which will be cleared up by the time we get to the March 2025
hopefully
Fed meeting. Yeah, hopefully. And so they have to pause and reassess. And so that's a 60% chance.
Yep. And so to that point of, you know, in total, a 90% chance here of avoiding a hard landing, right?
Yep.
And to what we were talking about earlier of matching up the willingness and capacity to borrow, maybe we can spell that out a little bit more looking at household debt service ratio here. Under 10% as we sit here today, the lowest level entering a rate cut cycle in history.
Yep.
And you can see how that's played out historically. We just looked at 2008. You can see that was a big old de-levering event for households. Compare that to the 90s cut cycle we looked at,
Yep.
where you're seeing households relever. So that's a good sign to start with.
Mm-hmm.
And then not to mention you've got all of these assets in money markets. Why is that beneficial?
Well, yeah, you have a record level of
Yeah.
money market fund assets relative to the size of the economy. And one of the things that always happens when the Fed cuts rates is cash yields go down. When the yield on cash goes down, holding cash just becomes less attractive on a relative basis. And so, you know, that money can get redeployed into other financial assets or into the real economy. Long-term fixed investments, whatever, it doesn't matter. I mean, if that gets redeployed almost in any way, shape, or form, you can see how that can really re-accelerate economic growth.
Yeah.
And so this starting point, if you're the Fed and you're trying to reinvigorate the economy, avoid a hard landing, this is about as good of a starting point. Well, it is. It's the best starting point you could ever have for that. So we think the economy will be pretty sensitive to those first few rate cuts, meaning the Fed's probably going to have to pause before they get anywhere close to the neutral rate of 3% on the Fed funds rate.
Yep. Recession signal remains inactive. Appears to be a good environment for rate cuts. Be interested to see how it plays out here. Mm-hmm. That'll do it for this edition of the Deep Dive by CAP STRAT. If you have any questions or comments, please feel free to reach out.